This is The Wealth Puzzle with Michael Mansfield from the Lynn Group. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Michael provides his clients and prospects with the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful solutions to put you on the path to achieving your retirement goals. And now, here is The Wealth Puzzle with Michael Mansfield.
Hi, everyone. Welcome back to The Wealth Puzzle with Michael Mansfield, and I'm Tana Pennington.
Mahalo, Tana.
Yeah.
Yes, Tana's here. Owen's there. I'm here.
Yeah.
Everyone's here. Thanks for tuning in. Interesting show this week. Tana and Owen put together a bunch of slides and PowerPoint and content on Mr. Federal Reserve. So next week, the Feds are going to start cutting rates. Are they going to cut a quarter point? Are they going to cut a half a
Or
point?
a half.
This is going to be exciting. Right? It's kind of like the presidential debate. You're all going to want to make popcorn and sit on your couch next on the 18th and watch the news at 11 a.m. to see what happens here in California. But what we wanted to talk about though today is, what does that mean? We've been talking a lot this year about the three-legged stool. What is driving the stock market? Earnings are an obvious component of that. The presidential election is a component of that. And we've harped on and on and on about this idea that the Fed rate cuts and the expectation of that also drives the stock market. On a really high level, Fed rate cuts are basically like giving steroids to the stock market. When you make money cheap and you make loans cheap and you accelerate the velocity of money into the economy, it helps speed things up and move things along, and earnings feel better and money is a moving. And so the Federal Reserve, treats the economy like me trying to teach my 15-year-old how to drive, right? You're sitting in the driver's seat, you're pushing on the gas, you're pushing on the brake. It feels very clunky and dysfunctional. Yeah. And that's kind of what's happening is, when the economy is too hot, there's too much inflation, there's too much going on, you push on the brakes, you slow everything down by raising rates and tightening up the money supply. When all of a sudden it feels like, okay, we're slowing down to a normal speed, we're ready to get going again here because inflation has come down, we feel that things are under control, blah, blah, blah. Then we start cutting rates, we start printing money again. Now, to be fair, it's pretty amazing that the Federal Reserve for practically 100 years has pretty much screwed this up every single time. The last time they had the opportunity to screw this up was in the late 70s. After going through a period of hyperinflation, the Feds did exactly what they're doing right now. They got it under control. And when it was under control, they said, hallelujah, we win. Let's print some money. Let's lower rates. And they created hyperinflation, like hyperinflation in the 80s that required the Feds ultimately raising the Fed funds rate over 20% to stifle out the crisis that they had created. So here we are again in 2024. We just went through the first wave, just like the 70s. We're sitting right here. The Fed's saying they won. Life is good. And we're going to see what's going to happen. But for the context of today, we're going to talk really about the stock market and our expectations of what happens in the stock market with these types of things. So look at this beautiful thing that Tana and Owen have made. Oh my gosh, highly professional. Tana, maybe as a side hustle, if you want to start doing PowerPoint presentation creation for people, you can charge $10 a page. All right, so what do you got for us, lady?
All right, so this is our first slide. This chart shows the Fed funds rate. And so the orange dots are showing us the rate cuts. And then the vertical gray bars, those are recessions. And then the thickness shows how long did the recession last. So, and this is illustrating basically over the last 100 years. So 16 out of the last 22 Fed rate cut cycles resulted or was followed by a recession. And so that's over, 75% of the time.
Wow. No, but that's a real, I mean, this is probably to me the best chart in the whole thing because it tells a story. It goes back to the analogy of driving the car, right? Did we push on the brakes too hard? Did we make a little bit of a mess? Did we get rear-ended in the economy? It is amazing that statistically, when the Feds are doing rate cuts, more often than not, we're either in a recession or going into a recession. We can argue causality. We can argue correlation. Do these two things make one the other, or the other the one? It's kind of the chicken or the egg maybe adage. But you're right. This is pretty telling, and it's amazing to see that in 22 rate cut cycles, more often than not, there is some recession correlated to it.
And I think if you overlay the fact that we are definitely more resilient in the last 40 years due to technology, transportation of goods and services compared to previous decades, back in the 30s, 40s, 50s, things were traveling at a lot slower pace across the United States and even globally. I mean, we have such a great outreach globally that I think it causes us to be more resilient.
No, and that's totally true, right? Technology has advanced a lot of things. I mean, even like when you visually look at the chart, it does feel like there's more gray bars on the left side of it than
exactly.
So there's almost like a sub statistic of, 73% or whatever it is of the time a recession follows, but maybe it kind of feels like more of them have also happened historically, in the good old days.
Right.
We beat the odds a little bit more in modern times. But we've also had to deal with very unique things. I mean, on the righter side of the page, the thicker bar is 2008. I mean, that was the worst financial crisis in 100 years. To only throw a good fight against the very far left giant gray bar from the Great Depression.
Right.
You look at the rate cutting that caused a micro recession, the small line on the very, very, very right side. Well, that's COVID. That's in and of itself a fake recession. The government was mandated to shut the economy down.
Right.
We instantly put 20 million people on unemployment. So that was almost a manufactured recession in a sense.
Right.
Percentages. Now, this is what's interesting though. So people hear recession and they think, oh my gosh, like what's going to happen to the stock market, Tana?
Yeah, panic.
It's all over. Deals are coming off the bus. Everything is sad and scary. The stock market is a very poor measure of economic health, in my opinion, right? Looking at labor markets, looking at spending habits, looking at credit debt, looking at default rates on cars. There's a lot of other things that we can use as economic tools to decide how healthy families are, individuals, all of this stuff. The stock market tends to be a little emotional, right? It likes to go up and down based on the whims of the day. We've lived in a lot of time periods here in the last 15 years where bad economic data actually makes the stock market go up because the stock market wants free, cheap money from the government. If they think the feds will cut rates, that makes the stock market go up. But what's the data on all this stuff? And so on the right side of this kind of green and red bar-y page thing, basically what we're looking at is we're looking at 18 occurrences of where the Fed started cutting rates and what happened. What happened after 1 year, 3 years, and 5 years. And I think that this tells a really good story. So on average, 12 months later after the Fed starts cutting rates, on average, just over 70% of the time, the stock market is up somewhere between 13 and 16%. So when the Fed starts cutting rates, statistically, more often than not, markets are up 1 year later. And the numbers only get stronger to this point. After 3 years after the Fed start cutting rates, the market is up over 80% of the time with an average total return over 40%. Well, geez, 40% over 3 years. That's not terrible. Yeah, I can take that. You go 5 years out.
Yeah.
You're crazy to not be betting on the stock market 5 years out from rate cuts. 100% of the time in the history of this country, 5 years out from rate cuts, the stock market is always higher to the tune of almost 100% higher.
Right.
90 to 100% higher. That's incredible. A 5 year run, that's an average return of almost 20% a year. That's great. Now, granted, we can go into the subcategories per Tana's point. If we go back to that one slide where we're saying, oh my gosh, after some rate cuts, there's a recession, and after some, there's not.
Right.
Like I said, in the old days, it seems like there was a little more often than now. But to that point, the data is certainly a little softer for recession hits. It says, after 1 year, the stock market's only up 65% of the time at 11% as a total return. Still, though, even if there's a recession or no recession, the markets are up 100% of the time after 5 years.
Right.
Things work through. They work through the system. So this goes to our constant adage with people is when you're segmenting and bucketing your assets, when you're doing long-term retirement planning, this is why we have our safe money, our balanced money, and our growth money. The growth money should be invested in the stock market.
Right.
And right now, with the idea that the Feds are going to cut rates, they're going to juice the economy, they're going to print money. This might be bad for inflation and economic things that we can talk about separately down the road. But for the immediate moment, it's a fool's errand to say, oh, I should just get out and assume, blah, 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 blah. Because the statistics
don't panic.
are against you.
Don't panic.
Oh my gosh, we have so many charts of this stuff that kind of tell the story in different ways. This one details more like sub assets, saying, well, what about the US market versus bonds versus cash and things like that? And the argument when you look at this of all these different rate cuts for 100 years is the stock market tends to outperform the more conservative stuff by double.
Right.
Bonds are up 6%, stock market's up 11, 12%, going back to those averages I was talking about just 1 year later. This is where this one's interesting. This is where you get into the hinkiness of the whole deal. And so when we talk about returns, everything feels like it's in a straight line. I'm going to make my 11%, in a straight line for the next 12 months. That's not how investing works, right? It's happy, it's sad. It's happy, it's sad. It's happy, it's sad. And so when the Feds cut rates, they don't instantly take hold. Got the economy in a hold. It takes somewhere between 2 and 3 months for a rate cut to actually work into the economy, where loans have been processed, money has changed hands, efficiencies have been created to start to see the positive outcome of that. To that point, if you can even see this, I know it's probably small on your phones and stuff, is the very first column here, the 3-month return. Basically what it's saying is on average, 3 months after rate cuts, the market's rather flat. Hasn't really done much. So it takes a little bit of time to get the ball rolling. But once it's rolling, then things look consistent. Now, this is a unique year. Tana, any idea what's happening in November?
The election.
Oh, I thought you maybe had a bar mitzvah or something to go to.
Yeah.
There's an election, right? This is a presidential election year. Presidential election years also have kind of their own, we'll say, unique set of statistical facts. If you've been in my office lately and talking to me, I've been kind of harping on the idea that, hey, everyone needs to chill out for the next 2 months, because the few months before a presidential election year, I got to just skip ahead. This is going to take too long. Sorry, Tana.
It's okay.
I don't want to devalue your work. This is kind of hard to see, but if everyone can kind of see this on the screen, the September to November charts. And if you look up where the charts are, for the most part, the blue, the red, and the black, they're all just kind of going down. The 2 months before presidential elections commonly are very volatile, very boring. And also there's cyclicality, right? September and October are generally pretty doldrum months in the stock market anyways. But leading into an election, when there's skepticism of what's going on, things are skeptical. And then what happens? And you see all the lines kind of right in November, everything starts to fly, right? Everything starts to go straight up in a line. Statistically, markets do really well after presidential elections. Honestly, it doesn't even matter who wins. The market likes the certainty of knowing what's happening, a certainty of expectation towards regulation, towards corporate tax policies. It just needs a little bit of understanding of what the deal is, and then it'll figure it out from there. So to that point, we're very optimistic that in the next time period, the stock market should trend higher. The Feds are cutting rates. This juices the market. Once again, creates some mild concerns over inflation and some other things that we'll be touching on a little further down the road here. But for the immediate moment, we need to buckle up for the next couple months, be patient through all of the chaos of, fighting with your friends and family about how horrible the other candidate is. And, and as long as we don't all eat our pets, I think we'll be good. Oh, you can't make political jokes, Mike. You're a jerk.
No, you can't.
So, oh, come on. If we can't laugh about things, what do we have left?
Yeah, right.
So in any case, thank you, Tana, for putting that data together for us.
Yeah.
Everybody, thanks for watching and listening. Obviously, if you have questions, concerns, if you're panicking about all this stuff, just call us. This is why we're here. We're more than happy to shoot the breeze and talk to you about this stuff. 805-500-7035. Obviously, visit our main website, thelindgroup.com. Otherwise, everybody have a great day. Thanks, Tana.